All right, thank you for joining me or listening in. My name is Michael, and we're going over a section of my real estate course. Quick disclosure statement. Please note that I am an unlicensed student studying for my state's real estate licensing exam. I am not a real estate professional at this time, nor am I representing myself as one. I am sharing my study materials for educational purposes and your consideration in the real estate industry. Materials may vary depending on your state. The federal portion of this course relates to all states. This content can be used as a study aid, but cannot be used as a supplement to your state's educational requirements for licensure. You must take an accredited course. Please see your state licensing agency for additional information and a list of applicable courses. If you Today's course, today's content is brought to you by the CE Shop. That is who I went through. This is not a paid endorsement. However, there is a link in this video. If you are interested, please click on that link. That link, if you do end up buying or paying for a course, will give me credits toward my future continuing education. And that's all it would give me. Um, and of course, if you like this information, please follow, subscribe, like, comment, share, any or all of the above, and I thank you. So today we're going through section 16 of my course. I've already passed this course. I'm going through it a second time because I took some time in between, give myself a refresh. I am almost done. Tomorrow will be section 17, and that will be the last section. After that, I'll be doing some study courses that I paid for through the CE Shop, and then after that, I'll be doing some study questionnaires through the state um, um, licensing company, third-party company that I'll be going through called PSI, and I may include some of those in some videos as well. So uh, again, follow me and so you can see additional videos that come up. So let's go into taxation and investment basics. This is somewhat geared for the state of Michigan, but most of this material will be either applicable or somewhat applicable to your state, just kind of depending. Um, and especially some of the federal tax implications, of course, would be. There are three lessons in this particular unit, and then a little mini exam at the end. The way that this course works is they give us some resources. We read the resources and we do a knowledge check. So let's get started. Tax credits and deductions. We've all heard the expression money talks, right? That applies here. Let's face it, tax laws are even better than sleeping pills when it comes to battling insomnia. However, not all tax laws or tax related topics are created equal. So before your eyes start to droop, let's take a look at this. Paying taxes isn't fun. This is why, come tax filing time, most people are looking to file all the tax deductions they can. A tax deduction, let's say a donation made to a local charity, means that the amount of that deduction is deducted or taken from your income on which you are taxed. So let's say you made $60,000 last year and you also made a donation of $500 to a local charity. Great. Now that 500 will be deducted from the 60K, so you only have to pay income taxes on 59,500. Sure, it won't make a huge difference, but even if it puts a few bucks in your pocket rather than in Uncle Sam's, that's a good thing, right? But we're here to tell you about something that's even better than a tax deduction, a tax credit. A credit is a direct reduction in the amount of taxes that are due. Let's look back at your $60,000 a year income from last year. When you do your income taxes for the year, you discover that you owe the IRS $550. What a bummer. But wait, you remember that you're getting a $500 tax credit. Now you only owe $50. Cheers for tax credits. The bottom line, tax deductions are good, but tax credits are better. All right, so let's read our resources. Tax credits for certain housing and renovations. All right, tax credits are direct reductions in the amount of taxes due. If you have a client who invests in renovating older buildings or in low-income housing projects, even if that investor is not an active participant in the management or operations of that building or project, that person may be able to use specifically designed tax credits to offset the taxes on part of their other income. While there's a maximum income level on these credits, any kind of tax savings, especially in the form of tax credit, is going to be welcome news to your investor clients. This brings us to the next tax credit, which has been available since 1976. It applies to those who renovate historic properties. People who renovate historic properties can take a tax credit on up to 20% of the money they spend to renovate the property. Historic properties, however, doesn't mean Great Aunt Fanny's 60s era duplex, which has been overrun by her 14 felines and enough backdated issues of People magazine to fill a library. It means bona fide historic properties, as in those that have been given that designation by the U.S. Department of Interior and are listed in the National Register of Historic Landmarks. It also applies to historically significant properties of that that are located in a historic district as designated by the state. A couple of additional restrictions apply. The property must be renovated in accordance with the federal historic property guidelines and certified by the U.S. Department of Interior. Once renovated, the property may not be used as a private residence by the people who renovated it and took the credit, but it can be used as a place of business or a rental. All right, next is tax reform, tale of two acts. All right, the Tax Reform Act of 1986. The Tax Reform of 1986, TR-886, is a federal law that simplified the U.S. income tax code. The law made numerous changes to the tax code, including downsizing myriad income tax rates to just two, eliminating some tax shelters, and altering or eliminating certain tax deductions. Eliminating accelerated depreciation, set straight line depreciation timelines, 27.5 years for residential, 31.5 for non-residential. Losses can only offset passive income unless investors' taxable income does not exceed 100,000 before the deduction applied, and investor is an active participant in the property's operation and management. Actively managing investors can shelter 25,000 of passive income or active income, but that shelter phases out as the adjusted gross income grows past 100,000. 25,000 tax shelter completely eliminated if AGI exceeds 150,000. The Revenue Reconciliation Act of 1993 further tweaked the tax code and updated the laws laid out in TRA 86. In particular, it eliminated certain tax shelter limitations for investors who meet specific requirements, increased non-residential depreciation timeline to 39 years. Unlimited rental losses can be claimed against non-passive income if investor actively participates in 50% or more in the management of the property, and investor performs at least 750 hours of service managing the property. So what does this mean for your investor? Consider real estate investor Ingrid. She owns several renter properties, but only handles about 30% of their day-to-day management. This means that Ingrid falls under the passive umbrella of the tax code. Last year, Ingrid's adjusted gross income, AGI, was $140,000, and her losses totaled $25,000. Because she earned $40,000 more than the $100,000 limit, her deduction was depreciated by 50 cents for every dollar of that 40,000, or 20,000. Bottom line, Ingrid could only claim a $5,000 loss. Therefore, her taxable income is $135,000. Remember, she can only claim that loss if she actively involved in operating and managing the rental property she owns. If Ingrid wants to avoid this limitation next year, she'll have to take over at least 50%, 750 hours of service, of the management and operation of her property. As noted in the list above, TR-86 doesn't allow investors to use a loss from their passive investments to shelter income that's considered active, such as salary, or counts as portfolio income, such as capital gains, royalties, stock dividends, etc. Overall, TR 86 limits the passive investor investment-based deductions to investment income. Keep in mind that special rules apply to real estate professionals regarding passive losses, providing the professional meets certain obligations or conditions. Once these conditions are met, and they must be met on an annual basis, a real estate professional isn't subject to the passive loss limitations. All right, let's do our knowledge check. Tax credit versus tax deduction. A tax credit and a tax deduction are not the same. Identify the differences between the two. This is the better of the two. A tax, which is better, tax credit or tax deduction? Tax credit. Okay. This is applied to the amount of taxable income. That would be deduction. This is a direct reduction in the dollar amount. Oh, I'm having a hard time with this one, aren't I? Let me see what you got. Tax, deduction, okay, credit, okay. No, I'm doing that wrong, aren't I? Direct reduction in the dollar amount. So tax deduction, the Tax Reform Act of 1986 applies to this one. Ooh, why am I having a hard time with this one? Let's go back. The law made numerous changes to the tax code, including downsides myriad income, eliminated acceleration depreciation. I'm gonna get this one really wrong. What did the Tax Act of '86 apply to? Did you already go ahead of me?
Yeah, deduction.
Deduction? Oh, I got that one. I got that one wrong.
Wait, is that wrong?
I got these two wrong. No, what you said was right. This is the better of the two, tax credit. This is applied to the amount of taxable income, tax deduction. This is a direct reduction of the dollar amount, tax credit, okay? And Tax Act Reform Act applies to tax deductions. Okay, credit's better.
Applied
Deduction.
to the total income is a deduction.
Deduction. This is direct
The
reduction of
amount
dollar
below
amount.
the IRS
It's a
is a
credit.
credit.
And the Tax Reform Act went toward tax deductions.
Deductions.
All right. All right. A little shaky on that one. All right, tax credit for historic restoration. Investors may qualify to receive up to 20% tax credit when a historic property is renovated and restored according to certain laws. The tax credit is applicable on the cost of the restoration only. Can you identify the other qualifications for classifying a property as a historic one? Historic properties are did we do this one? No, we
Not
didn't.
this morning.
No, I'm saying I haven't read this tax credits for certain housing and renovation. I haven't read it yet.
Oh, no,
Uh,
I didn't either, I guess.
Tax credits for certain housing. Well, where'd that one go? I don't even have
There
that
was
one.
two.
Oh, wait. Yeah, I read that one already.
Yeah,
Okay, never mind.
we read it already.
Yeah, okay.
Historic properties.
Investors, okay, okay. Historic properties are. Oh, your book is going to arrive today. Historic properties are designated by the Department of the Interior and are a historic landmark. Meets qualification, I would assume. A duplex built in 1950 is being restored by a couple who plans to occupy the property. It does not. An old Victorian style home located in the historic district. I think that would meet it.
That one's questionable.
Renovations meet the federal historic property guideline. I'm going to say meet. Yeah, I got that right. All right. Knowing what classifies a historic property will be helpful to clients who inquire about the restoration of such a property. Good. All right. All right. There are some differences between Tax Reform Act of '86 and '93. Can you spot the difference? Increase the non-residential depreciation timeline to 39 years. Was that the?
I can tell you, but
Oh yeah, that's the Revenue Act reconciliation. Set the straight line depreciation for residential 27. That's Tax Reform Act, I believe, right? Yeah. Unlimited rental losses can be claimed against non-passive income only if the investor is active in 50% or more of the management of the rental and works at least 750 hours. Is that the revenue reconciliation?
I'm saying that's the Tax Reform Act, but I got that
No,
wrong.
that's the revenue
I got
reconciliation.
the bottom two wrong.
Actively managing investors can shelter 25,000 of passive or active income. However, the shelter reduces an annual gross income grows over. Is that the revenue reconciliation? Nope,
No.
I got that one wrong.
I
So 2121.
unlimited rental
One.
losses against non-passive.
Uh-oh, my wheel's not working. What's going on here? Oh, there we go. 2121. So that's the Tax Reform Act. Okay. God, I hope they don't ask too much about that crap. Why would they? We're not tax people. I mean, I know we're supposed to have a
It's
basic
because we
understanding
get
of certain things.
these questions every day.
Yeah, you would guide the person to a tax specialist.
Yeah.
All right. Investors and depreciation in Michigan, lesson two. One aspect of taxation that separates investors from other real estate owners is depreciation. Depreciation allows the investors to recoup some of the costs of managing an investment property by claiming a tax deduction. There are a couple of ways that investment properties depreciate, and we'll get into that here. And the one thing I just never did is I never checked to make sure. I got a voice check here, so let me just do that. Depreciation allows the investors to. There's my voice check. Okay. Um, all right. Why is it kind of fuzzy on the screen? Oh well. On to the next. All right. So we need to read depreciable basis for investment properties. Here we go. You've likely heard the terms depreciation and basis, so let's get those two terms defined. Depreciation. Depreciation is defined as an asset's reduction in value. We'll be talking about tax depreciation here, but there's also economic depreciation, which an accountant or appraiser may use for various purposes. Tax depreciation is a theoretical loss in value over time as a result of typical wear and tear. It's used to calculate a business deduction based on an assumption that property has a limited service life because of depreciation. Economic depreciation is an actual loss of value, whether it's far from wear and tear or from external factors, for example, a fire damaged the building, there was a downturn in the local economy, or the business climate saw unfavorable changes. Basis. Property basis is essentially its acquisition cost, including the sales price and related acquisition fees, and any capital improvements like renovations or additions. An investor uses the property's basis to figure a number of tax-related things, just such as the amount of gain or loss on a sale. It's called depreciable basis when it's used to calculate the tax deduction allowed for its depreciation each year. More about tax depreciation. First off, tax depreciation is limited to investment properties. You can't do this on your personal residence or your vacation home. The land itself can't be depreciated either because it never suffers from wear and tear over time. The depreciable basis is an investment property an investment property excludes the value of the land it sits on. Debt service, the cost of repaying the loan, is not depreciable, and certain commercial assets may depreciate even faster in some instances. Tax depreciation is good for investors. Investors like tax depreciation for good for a couple of reasons. It's a form of cost recovery. The investor recovers the cost, that is the basis of the asset, over the asset's useful life through tax deductions. It allows investors to shelter some of their earned income. investment income. So not only is the property appreciating in value, meaning it's worth more than the investor originally paid for it, and tenants are paying the mortgage in ever increasing lease payments, so the investor's cash flow is growing, but the investor also gets to offset some of that income by depreciating the value of the property over time. Sweet. And whether it likes it or not, the IRS actually requires investors to take their depreciation. They don't have a choice in the matter. Recovery period, residential income versus commercial. IRS rules say that residential income producing properties are depreciated over 27 and a half years, while commercial properties are depreciated over a span of 39 years. That's called the recovery period. You're allowed to prorate for partial years of ownership. Once you've reached the end of the recovery period for a property, you can no longer claim the deduction for depreciation. Formula for calculating the basis. Remember, the basis includes the sales price, acquisition costs, and any capital investments, like renovations or additions. So the calculation for determining basis is sales price plus acquisition costs plus capital improvements equals basis. Formula for straight line depreciation. In general, tax deductions are calculated using a method called straight line depreciation. Basis divided by recovery period equals allowable tax deduction. Putting it all together, let's look at some examples of calculating the amount of depreciation an investor would be allowed to take each year. Example: the building's basis is $500,000. The investor actually paid $600,000, but the basis excludes the value of the land. It's a commercial property, so it's depreciated over 39 years. The investor has owned the property for 5 years, and since he hasn't done anything to require an adjustment to the basis, such as capital improvements, his tax deduction for depreciation is the same each year. 500,000 divided by 39, which is $12,820.51. Example 2. Ron owns a duplex, and he rents out both units. The depreciable basis of the property is $250,000. His annual tax deduction using the straight line method of depreciation and a recovery period of 27 and a half years is $250,000 divided by 27 and a half years, which is $9,090.91. A final warning. We're sure we don't need to say this, but our discussion of depreciable basis doesn't constitute tax advice. The IRS rules are complicated, so always consult a tax professional for actual tax calculations. All right, let's do our knowledge check. With regard to investment property, what are the two types of depreciation? Economic and tax. Yay. Do you know what the two types of depreciation are? No, oh, sorry, you know. You now know what the two types of depreciation are. But what else do you know about depreciation? Let's find out. Review each statement about depreciation and determine if the statement is true or false. One example for economic depreciation is when the asset is actually worth less because it's deteriorating physically. True, that would be economic depreciation. Yeah. Tax depreciation is when the investors take an actual business deduction by depreciating in an actual asset. I think that's true too. Depreciation is limited to homeowner occupied and investment properties. That's false. The IRS required investors to depreciate their investment properties. Requires them to, yes. Tax depreciation is cost recovery. I believe so, yeah. The basis of an asset includes the sale price, acquisition fees. Well, let me start that over. The basis of an asset includes the sale price, acquisition costs, and any capital improvements. Acquisition capital, sales price. Yeah, looks like that might be true. Yeah, we did it. All right. What is the name of the method that investors use to calculate their annual property deduction? Uh, is it the depreciable basis or straight line depreciation? No, we're going to go with straight line then. Yeah. Straight line depreciation, the name of the method that investors use to calculate their annual property tax depreciation. All right. Straight line method for, we're still on depreciable. Sure, I don't have a new read thing. Okay. Straight line method for income producing residential property. For income producing residential property with straight line method, would an investor use which straight line method would an investor use to calculate the property's annual depreciation allowance? Residential property would be 27 and a half years. Income producing commercial would be 39 years. And it looks like we're done with that lesson. Yay, because this is definitely something that will put you to sleep. All right. All about 1031 tax deferred exchanges. Now, if you're listening to this video, you hear me talking to somebody else in the background. It's my spouse. We're both taking this course, so you'll hear me talking to him from time to time, helping each other. We're both studying. All right, all about 1031 tax deferred exchanges. Under Section 1031 of the Internal Revenue Code, the owner of real property can sell that property and then reinvest the proceeds in a like-kind property to defer paying capital gain taxes. To qualify as like-kind, the exchange must be done according to the tax code rules. It does not mean you have to replace an apartment building with an apartment building. Investors can significant tax reap? What is that? Reap. Investors can reap significant tax benefits by taking advantage of the 1031 exchange. And in some cases, some areas, boy, I'm putting words in there that just don't belong. It's considered one of the best kept secrets in the Internal Revenue Code. A property structured exchange can provide investors with the opportunity to defer all of their capital gains taxes. This results in an essentially interest-free, no-term loan from the government. Instead of paying the taxes now, the investor could put those dollars to work on other investment properties. To qualify, the property must be held for investment or business purposes. Sale proceeds must be passed through the hands of a qualified intermediary and must not be received directly by the investor or they will become taxable. All proceeds must be reinvested. Any cash proceeds retained will be taxable. The replacement property must involve an equal or greater level of debt than the relinquished property. If not, the investor will have to either pay taxes on the difference or put in additional cash funds to offset the lower level of debt in the replacement property. All timelines must be met. Property identification within 45 days, closing within 180 days from the closing date of the relinquished property. Foreign investors may also participate in 1031 tax exchange and are subject to the same rules of qualification. An investor can't defer capital gains on a warehouse by purchasing a family home in which the investor intends to live, nor does most personal property qualify for the 1031 exchange, even if it's used for business purposes. Investors can exchange property that's residential, commercial, industrial, or even leased if the lease is for 30 years or more and includes ownership interest. Investors can exchange into vacant land, hotels, motels, etc., provided the exchange meets certain IRS rules. Parsing the IRS rules. First, there's the like kind rule, which we've already discussed. Second, the basis of the original property carries over to the new property. It doesn't change. So if your investor has a property worth $500,000 with a basis of 100,000 and then exchanges it for a property also worth $500,000, the basis in the new property is 100,000 plus any new debt taken on and any cash paid out. Rule number three. Rule number three is that the new property has to become, oh boy, the new property, rule number three is that the new property has to come with the same or greater debt load for the investor. If it doesn't, the investor will be liable for gains on the difference. The IRS doesn't want the investor pocketing any change on gains realized. This is simply a way to defer gains from one property by investing those gains in another. To be clear, any cash your investor receives from the proceeds of the sale is taxable. It's called boot. Boots down the house. It doesn't mean there can't be a tax deferred exchange, but the taxes on the boot are due and payable. Rule number four. Rule number four is that the investor has to use a qualified intermediary to conduct the exchange. What makes an intermediary qualified according to the IRS? Simple. He or she is not unqualified. Okay. In case that's unclear as mud, your clients can't do the exchange for themselves, and if they worked with the investor in the past 2 years, neither can the investor's attorney, CPA, or you, the real estate broker. You're not qualified. Joe Blow, unlicensed and unaccredited, who doesn't know your client from Miley Cyrus, is qualified. So Joe Blow, whoever he is called a QI or qualified intermediary. The QI will coordinate the exchange between the parties and their attorneys or agents, coordinate documents and money transfer through escrow, and submit a 1099 to the taxpayer uh, and the IRS for proceeds paid. Rule number five. Rule number five, and it's a biggie, is that the investor has only 45 days from the day of closing on one property to identify and commit in writing to the next property. The investor has 180 days from the date of sale of the property one to close on property two. Those are firm dates, and there is only one way to extend those dates. The President of the United States has to declare a natural disaster area that affects the properties or parties involved. No fooling. This time frame can get hairy if you're in the middle of negotiations and the clock is ticking. Your investor client has a lot more to lose than the seller of property 2 at this point. So keep these deadlines in mind and identify early, negotiate exponentially, and sew up the deal before you run into trouble. Rule 6. Disclosure of the exchange is rule number 6. The 1031 must be disclosed to the buyer at the time of the sale and at the time of the purchase. You have to tell the parties to the transactions that you're doing a like-kind exchange. If your client changes her mind about the property in the middle of the exchange, her tax deferral may be in jeopardy due to the deadlines involved. If the change of heart occurs during the 45-day identification period, and by the way, the 45 days includes Saturdays, Sundays, and your birthday, so don't even think about any grace period until the next business day. It's 45 calendar days, period. If it if it happens during these 45 days and your client hasn't yet closed on the sale of the property being sold, ask for an extension from the other party. Hopefully, though, you've identified a backup property just in case. If so, eradicate, I'm sorry, if so, extricate, yeah, yourself from the first listing and quickly get the other in writing within that 45-day window. The formal identification has to be made with the QI through fax, mail, or courier. The investor must do this in writing during the 45 calendar day identification period. Once the 45 days is up, that's it. Revoking and submitting a new property for exchange will not reset the deadline. So unless you think you can get the POTUS to write you a note for the teacher, forget about it. Okay. And if you get a slippery QI who suggests changing or backdating the paperwork, fire him on the spot. This is called criminal income tax fraud, and even the president can't write you a note for that. All right. Um, where are we? Let's could pardon you. Yeah, right. Let's say you fail to identify a property in 45 days, or the deal falls apart and you can't cobble another one together within that 45 days. What happens? It's not the end of the world, but it is the end of the investor's chance to do a 1031 for the deal. Game over, pay your capital gains tax. The 180 days is also firm unless the deadline becomes shorter. The rule is that you have to complete the 1031 exchange by the earlier of either midnight of the 180th calendar day following the close of property one or the due date of your client's federal income tax return for the tax year in which the relinquishing property was sold, including any extensions. This only becomes a problem if property one is sold between October 17th and December 31st of any given year, because that would mean the 180th calendar day would fall after April 15th tax day. Additional IRS rules. Just in case you think just in case you think you were done with the rules, remember, we're talking about the IRS. There are three more rules you should be aware of related to the identification of the replacement property. 200% rule. Multiple properties are okay, but may not exceed 200% of the value of the relinquishing property. 95% rule. Multiple properties are okay as long as they total at least 95% of the value of the relinquishing property. And three property rule. Up to three properties are okay with no fair market value restrictions. First, let's talk about the 200% rule. Your client could decide to exchange into more than one property. That's perfectly permissible. Remember that the debt load has to be equal or more than the current debt load. There's also a cap. While your client can identify multiple properties to exchange into, the combined fair market value of the properties can't be more than 200% of the value of the relinquished property. So if your client has a property worth 100,000 and can find 18 properties to exchange into, that's fine as long as those properties total value isn't more than 200,000. Then there's the 95% rule, which says that your clients can't identify a bunch of properties with no regard to their value if the exchange they're moving into has a total value of at least 95% of the value of the property they're selling. So if your client has a property worth a million and identifies six properties with a total value of 950,000 or more, you're good to go. Because both of these rules can be a bit confusing, most people go by the three property rule. That's the last of the property identification rules from your friends at the IRS. The three property rule says that your investor can identify up to three properties, replacement properties, and in this situation, fair market value doesn't matter, provided they meet the debt load requirement we've already discussed. For simplicity's sake, you can think of these as just two rules. As long as you meet the debt requirement, you can exchange up to three properties at any value. If you exchange more than three, you have to have a value of 95 to 200% of the relinquished property. If your client finds and closes on an investment property and then decides to sell another property, he can do a tax deferred deferral backward. This is called a reverse exchange. You're still strapped to the 45-day and 180-day deadlines, though, and it can get hairy. All right, whew. Let's do our knowledge check. A tax-deferred exchange for properties used for investment or business properties is also referred to a like-kind or 1031. Yes, true. A 1031 tax exchange is used to defer paying taxes when there is an almost immediate repurchase of what's called a like-kind property. Yes, that's right. Income producing residential, commercial, and industrial property can qualify for an exchange. Hotels and motels can also apply. Could income reducing residential qualify? I
Yeah,
think so.
not personal residential.
Not personal, but income producing, right? Yeah. All right, we'll say yes. A 1031 exchange can also be applied to a primary residence, similar to the no. Investors can defer capital gains using 1031 exchange for real estate exchanges only. Personal property such as equipment cannot be tax deferred.
I'm going true, but I don't
Is
know.
that true?
I don't know. I'm saying
For real estate exchange, okay. Real leased property can also qualify for an exchange as long as the lease is 25 years or more. I think that's false. I think it's 30 years.
it's 30.
Yeah, it's 30 years. All right. True or false? Any cash an investor receives from the proceeds of a sale is called boot and is taxable. I think that's right. I know the cash is taxable. The 45-day identification period does not include Saturdays and Sundays. False. An investor can revoke and submit a new property for exchange as long as a formal identification is made to the qualified intermediary within 45-day identification period. I think so. Yes. If an investor fails to identify a property within 45 days, or if the deal falls through and the investor isn't able to identify a new property within a 45-day window, the investor's chance to complete a 1031 exchange for that year is over. I believe that's right.
For that
Invest
property.
for that property is. Oh wait. Well, yeah, if they've already closed on the property, right? Yeah. I'm going to say true. What do you
I'm
think?
saying true.
Okay.
Not 100%.
An investor must complete the 1031 exchange by the earlier of either midnight on the 188th calendar day following the close of the relinquished property or the due date of the investor's federal income tax return for the tax year in which the relinquished property is sold, including any extensions. Yes, that's true. If investors decide they do not want to complete an initiated 1031 exchange, they can receive their cash immediately. They do not have to wait until after the exchange period. They do not want to complete an exchange, they can receive their cash immediately. Well, I would say that's true because if they don't do the exchange, they just take the cash. They wouldn't. Hmm. I don't
Must
know.
decide they don't want to complete.
Oh, I was wrong on that one. That's the only one we got wrong.
They receive their
One,
cash.
two, one, 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 two, one, two, one, 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 two. If investors decide they do not want to complete an initiated, they can receive their cash immediately. They do not have to wait until after the exchange period.
Which of these activities
Hmm.
caused by replace
That
proceeds
doesn't make sense to me.
handle paperwork, replacement mortgage, provide transfer data, submit
Okay. If investors decide they do not want to complete an initiated, so they initiate the exchange but drop out of it, they still have to wait till the end of the 45-day period. Okay, fine. I get it. Very specific wording there. Which four of these activities are the responsibility of a qualified intermediary? So we know it's not change or backdate
has to be these ones.
and not, yeah, they don't do anything. They don't provide a list. They
Well, that's
place
that's
proceeds of the first sale with escrow with instructions, handle transactional paperwork with the escrow, provide transfer documents for the exchange, submit a 1099 to the taxpayer and to the IRS for any gross proceedings paid out. Cool. Read each description that is related to the identification of replacement property and match it to its associated rule. When exchanging more than one property, the combined fair market value of the properties can't be more than the 200%. That's the 200% rule. That's going to be the 95. An investment can exchange multiple properties as long as the property's total is at least 90% of the value of the relinquished property. That's the 95% rule. An investor can identify up to 3 replacement properties with no fair market value restrictions provided they meet the debt load requirement. That's the 3 property rule. Yeah, that was pretty dumb. When would an investor who is involved in a 1031 exchange consider entering into a 1031 reverse exchange? Um,
I think it's the second.
I think it's the second one. The investor closes on the replacement property before selling the original.
Yeah.
Yeah, that's it. I was to say, once you close on the first property, you're kind of screwed. All right. Let's take our unit exam. 10 questions. Now, we won't see the answers till we're done, unlike our little knowledge checks that tell us right away. A 1031 tax deferred exchange, in a 1031 tax deferred exchange, what role does the qualified intermediary serve? Acts as a trustee, I think. Which of the following could an investor who sells an apartment house by using a 1035-1 exchange? An apartment house by using a duplex, office building, or warehouse. The sales price, acquisition costs, and capital improvement costs, such as renovations or additions, of a property combined to make up what? Sales price, acquisition, and capital improvement. The basis. What is reverse exchange? Investor finds and closes on investment property and then decides to immediately sell another investment property. A homeowner finds and closes on a house. No, homeowner, it's not homeowner. Investor sells the property and then finds, closes on another investment. We'll do that one. Investor, I'm a ghost. I'm a ghost, okay. Who makes about 80,000 a year, has a penchant penchant for historic properties. She decides to purchase historic property that has been designated as such by the Department of the Interior and listed in the National Register of Historic Landmarks. She hires people to renovate it and then make it her forever home. Later, Ima is devastated to discover that she hasn't qualified for the tax credit. Why hasn't she qualified? She makes too much money. She was not actively involved in the renovation. The renovation, the renovated historic property cannot be used by Ima for her private residence. The credit only applies to investors who renovate at least 3 historic properties per year. Um, well, sugar. Let's see. Tax credits are direct. This brings this tax which is available applies to those who renovate. People who renovate historic properties. Uh, Property must be renovated in accordance with the federal historic property guidelines. Once renovated, property may not be used as a private residence. Okay. Cannot be used as her private residence. Okay. Jimmy is a real estate investor, owns several rental properties in the area. After the economy took a turn, he was relying on TRA 86 to be able to deduct some of its losses. He is active in the management of the properties and his taxable income is 90,000 a year. What is the maximum deduction Jimmy can claim on his taxes to make up his losses on those rental properties? Hmm. Not exceed 100,000, 25,000. Recently, Francine and her husband Francine and Frank, decided to purchase and restore a historic home in the downtown area. To be eligible for the tax credit for these renovations, Francine and Frank must follow specific federal guidelines when they renovate and restore the home. In addition, the home must be designated as an actual historic property by which of the following? Department of the Interior. What advantage does the 1031 tax deferred exchange offer? It allows investors to avoid ever paying taxes from gains realized on their investments. It allows investors to defer capital gains taxes when selling a property, providing they buy another property. It offsets capital gains for homeowners who have lived in the home for at least 2 years. It provides a tax shelter for non-real estate. Now, number two. Investor Igor made 120,000 last year, but had 25,000 in losses from his rental properties. Can Igor take the full $25,000 deduction on his properties, assuming he is actively involved in a management operation of his properties? No, Igor's $25,000 will be decreased by 25 cents for every dollar. No, Igor's 25,000 will be decreased by 75 cents for every dollar, by 50 cents. Yes, all investors can deduct the first 25,000. Yes, in this case, because Igor actively managed and operated, he is allowed. Oh, no. So it's the Igor's 25,000 deduction will be decreased by 50 cents for every dollar he makes over 100,000. So if he made 50,000, so 50,000 of that will be reduced. So that'd be he get 15,000. I think is what it would come out to. What is the 200% rule as it relates to tax deferred exchanges? The combined fair market value of the property or properties being exchanged into cannot be more than 200% of the relinquished property. I'm just going straight with that. Let's see how horrible I did. 90%. Oh, I only got one wrong. I was kind of prepared to get more than one wrong. Coordinates the exchange. Okay, that's. I was stuck between those two. I knew I might be wrong on that one, but hey, I got them all the other ones right. I'm happy for that. All right, continue to Unit 2 commercial, industrial, and income property investment. Let's take a look and see what that's coming up. I'm going to stop this video, take a 5 maybe 10 minute break, and then restart it with the new information if anybody should happen to be watching, which doesn't look like